A lot of people say that when the central bank, whether it's the Fed or the ECB or somebody else, when they expand their balance sheet, that's bad for equities because there's a debt overhang. That's far from the truth. The truth is that the more debt that is out there in the markets, in the economy, the more deposits there are in banks for corporations and individuals. Now, when that's the case, the so-called economic theory of spending power or aggregate demand goes up. So that should be good for equities. That should be good for risk assets. The danger is when that debt overhang contracts, which is exactly the scenario we're in now. We're in a scenario where the central banks like the Fed, which may be operating on close to $4 trillion of balance sheet expansion at this point, has created huge amounts of deposits in the system. And those deposits have chased risky assets in the absence of yield. As that changes, as that contracts, that's got to be bearish. That's structurally bearish. And we've seen that. And what you can say is that even though not every credit crisis is the same, everyone rhymes. They might not be identical, but they rhyme. And the way that they rhyme is that credit contraction from a high level tends to be a leading indicator of crisis. Why? Because all of that demand that is piling into things that have yield or that have momentum, even at the margins, if it disappears, it's bearish. That's where we are now.